Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, "The ultimate in real estate is being the bank." And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
As you see, this is the money multiplier presentation I have up here. If you guys are here today, a part of our Take Back Control Tuesday presentation and webinar we always do, this is the basic. This is 101 infinite banking. This is 101 learning how to take back control over your financial future. And so if this is your first time being here, I'd love to see you guys in here. What in the chat? This is your first time? How many of you guys, this is your first time being here? First time being a part of our community, learning about IBC, don't even know what that means yet. That's okay. Well, is this your first time, anybody? Give us a little thumbs up or raised hand. A few of you guys. Yep. Herbert, I know I've seen you before. Anyone who's been here for 10 years, 5 years, you know, who's been a part of this for a long time. I've seen a lot of you guys in here actually many times before. And, you know, it's always good to come back and talk about infinite banking and the basics. Even if you had a policy for 4 years like Don, it's always good to remember the basics. Because I think when we're in it, we're doing it, we kind of forget the very simple aspects of it. And so I'm glad you guys are here. If this is your first time or your 100th time learning about infinite banking, thank you for being here today. So we're going to talk about something today that's blown my brain, blown things away from me and changed my life, and it's going to change yours. I know it. We're going to talk about how we've been taught to assume risk on our money, and it's costing us financial freedom. You know, the wealthiest families, corporations in American history have used what I'm going to talk about today. This is a 200-year-old strategy, very old concept that's been used by the wealthiest families to eliminate debt, to minimize their taxation, and to leave a legacy for their families. And I'm going to show you how to do all of this today just like they did, without working any harder, changing your cash flow, without losing control of your finances. And I'm going to show you, most importantly, how you can become the bank. And if you think that expression sounds too good to be true, it must be, right? That's what everyone says. But that's what I actually first thought when I learned about this method, this strategy. And so I'm going to be here today to prove to you and show you how you can utilize this. And it's not just for those wealthy families, but it's for everyone in America. I personally believe anybody can do this strategy. But as long as you have some strong financial pattern or habits, you're able to save money, you want to be better in your financial life, this is something for you. So let's start with a question. I love to have a very interactive webinar. I really wish we were in person right now, but this is basically the equivalent, except you guys are all at home on your phones. But I want to have the same type of interactions. So the more emojis, the more messages, the more comments, thoughts you put into the chat, that's how we're going to communicate today. And so I want every single one of you to be communicating as much as you can, because the more you put into this, the more you're going to get out of this. And so please be enthusiastic and communicate with us. Let us know everything you're thinking and feeling and wanting to share with us. So I love people already throwing things in the chat, but let's dive into it. Question for you guys to start here. How many of you at one point or another in your life felt like you had no control over your money, over your financial future? I feel like most of us feel that way most of the time, but let's see it in the chat. Let me know. How many of you are here because you're looking for ways to better control your money? Well, that's amazing you guys are here. I see you guys in the chat lighting it up. It's amazing. Thank you guys for being here. Well done. You guys are fabulous. Wherever you're at on your financial journey, I welcome you and I congratulate you. Because first off, why? Why do I welcome you and congratulate you for being here? What do I mean by that? Well, there's so many people out there that just talk. They claim they want to be better, but they're not here. Thousands of people saw the ad to be here, saw the different videos on YouTube to come to this event, and they didn't take action. But what you and I have in common today is that we're both here. We're both on this journey together. Now, whenever I walk into a webinar like this, I always think to myself when I'm on your guys' end, what am I going to get out of this? What am I going to get out of today? And so I wanted to just start with that so you guys understand what it is right off the bat. First off, it's going to be protection, because who doesn't want to protect the hard-earned money that they make? The second we're going to talk about is tax-free growth, because there are smarter money moves we can make. Why not take advantage of them? The third is leverage, because there's different resources in our life, money we have, things leaking in the back that we can leverage better. And last, legacy. We're going to hit this one hard, because what you learn today, you're going to need to and want to share with your family and your friends. They all need to learn this, and so that the next generation can have these different tools as well. So we're going to hit these 4 things. And I have a system that will help you accomplish all of these things. So if today you could take home a blueprint from me with all of these things, would you guys say it'd be worth your time? Yes? Worth your time today to get those 4 things, a little blueprint about how to do this? Now, I guess it would make sense for me to share a little bit about myself, just so you guys have confidence in your speaker. So this is my wife and I, Anna. Again, my name's Carson Herline. We live in Southern California. But over the past few years, I've built a foundation to not just be rich, but to build generational wealth. And I can sum that entire experience up with 2 words: gratitude and choices. I am so, so grateful that I get to feel secure and confident in our financial future. And I say choices because I get to choose every day what I want to do. If next month Anna and I wanted to go to Europe, we could. We could drop everything and go. And that's pretty freaking awesome. To have that financial freedom has bled into our lives where we have the freedom to do whatever we want. And my story actually is pretty simple. I mean, I'm sure most of you can relate to it, because in my early years, I made a lot of mistakes, as young people do. But when I was 18, I made a very smart decision. I actually went and served a church mission where I lived abroad for a year, and I just served people. It was a wonderful experience. And when I came home, I was in school. I had all these different outside influences pushing me different directions. In one hand, I held the traditional route. I held schooling, internships, working in the financial district. I held, being good at a good employee is what I was learning about. I was going through school. Well, in this hand, I held entrepreneurship. I held real estate investing. I saw other business owners that had freedom and control over their lives. And I had kind of to make a decision. Which route did I want to take? And when I made a decision, I had to decide, do I want to kind of work for the corporation, be a part of the rat race, people call it, or do I want to learn how to make money work for me? And it was that tension pulling these 2 things apart that brought me to a point of decision. And that decision to drop out of school and pursue a game and an education in investing changed the trajectory of my life. And above all, what's most important to me is family. How many of you guys here would like to have more money, to spend more time with your families? I mean, that's most people's whys, right? So yeah, 100%. I see you guys chatting there in the chat. So let's talk about statistics to start today. I think someone mentioned it earlier, but let's talk about the 5%. You guys here today are what I call the 5% because you're here. But if I was to go around and ask 118-year-olds right now, hey, when you're 65, will you be wealthy and successful? I guarantee you every single one of those 18-year-olds would say yes. Of course, there's no doubt in my mind. But something happens, something changes from age 18 to 65 that changes the whole dynamic. The Social Security Administration said 5 out of 100 people will be financially secure at retirement age. Guys, think about that. How is that even possible? In America, the land of opportunity, in this great country we live in, how many of you would agree that that is just wrong? That means 95% of people are going to be working until age 70, 80, 85, taking second jobs, not because they want to, because they have to. And this is financially secure. This doesn't even mean rich, wealthy, happy, comfortable. This is just secure enough to survive. Guys, I want you to know just by being here today, you are getting yourself to be a part of that 5%, or you are a part of that 5% already because the 95% aren't here. And the biggest difference between you and them is your willingness to invest your time, your money, and your effort to learn something new. So let's talk about some serious 5% stuff today. Why aren't more people successful? I think there's a lot of things. I think there's wealth killers and there's a mindset that needs to be had to be successful. Wealth killers like taxes, inflation, volatility. Your money has to fight through all three of those things just to get out the back end. And these things are getting worse, more expensive, and harder. And then the mindset, after you make it out of those three things, if you follow the status quo, there's no way you will be successful. If you live in fear, there's no way you'll be successful. And then life always comes up, right? Things always happen. So these 6 things, I think, are incredibly difficult, or things that make it incredibly difficult to become successful. Now, I want to hit this quote. This is one of my favorite quotes. I want you guys to start with this. The problem in America isn't so much what people don't know, it's what people think they know. That just ain't so. A lot of what we've been taught about money may not actually be the truth. So I need you guys to keep an open mind during this webinar because I'm going to challenge the way you think about money. How many of you guys, when you were younger, learned how to ride a bike? I'm sure every single one of you, right? Well, kids learn how to ride bikes fast, and then it's a muscle memory thing. They have it forever. And so there's this experiment done on YouTube. It's called the backwards bicycle experiment. This guy wanted to see if he turned the handlebars backwards, if he'd be able to ride the bike still, something he's been doing his entire life. And in this experiment, he got up on the bike, he took a couple pedals, and then he fell, thinking that's weird. He knows how to ride a bike. He gets back up on, takes a couple more pedals, and then falls. He did it for hours on end, and he couldn't figure it out. Eventually, he did. Eventually, his mind switched. He was able to ride the bike backwards, and he got it. And then he actually tried to go back the other direction and ride a bike normally again. And it was like he'd never ridden a bike before. He got up, fell over and over again. I shared this with you. It's a great YouTube video. It's a funny experiment. You actually should go look it on YouTube. But I share this with you because when you learn something one way, it's very hard to change. And the same is true for money. Since we were little, we've been trained how to think about money. But what would happen if I told you that what you were taught was wrong? It'd be very difficult for you to change to the new way of thinking, wouldn't it? But it isn't impossible. Eventually, you would learn how to ride the bike backwards. So earlier I mentioned we're going to be talking about a concept that's 200 years old, that the wealthiest family and people have used. People like the Rockefellers, the Rothschilds, the Stanleys, the Morgans, right? Well, there's also many books written about the concept. Second Chance by Robert Kiyosaki. Most of us know that name, big name in the business world. He wrote a book all about this strategy. Everyone knows Tony Robbins, right? Money Master of the Game. In chapter 5, he talks all about using this concept. And then the book Becoming Your Own Banker is the foundational book to learning this strategy of infinite banking. And these 2 books at the bottom were done by my mentors who wrote a little more modern version of this strategy and their way of, and their perception of how to utilize it. All these books are fantastic. Now, there are many mysteries around money and mysteries around this concept. And so let's just talk about how money works. Let's go back to the mysteries of money. This is where I want everyone to kind of chime back in. I want to hear your guys' thoughts here. What is your definition of money, guys? What do you think money is? What is it to you? We have a quiet group today, guys. You guys are all right. Those of you who contributed, money is just a means of exchange. That's it, right? Money for food, food for money. Money for car, car for money. Money for house, house for money. Nothing more than a means of exchange. Then what if I ask this next question, which I kind of gave you a sneak peek to? What companies use compound interest? What do you guys think? What would you say? Do companies use compound interest? If so, what kinds? What companies? Let's see the chat. Banks. That is the most common answer I usually get is banks. It's funny though, because actually not one business uses compound interest. But let's focus on banks because that's, like I said, most common answer. Banks don't make compound interest. They charge you compound interest, but they don't use it themselves. Because if I was to go to the bank right now, go down to my local Wells Fargo and I deposit a $20 bill, they're not going to write my name on it, put it in the back in a folder with Carson's $20 bills and leave it there. No, it goes immediately out in motion. They lend it out to someone else right off the bat. There isn't a business in the world that uses compound interest, and nor do banks. Banks keep money in motion, just like you should. But you haven't been shown how to do so. You've been taught to park your money and leave it in somebody else's control. But today that has to change. Because if I had another question for you, what about this? Are your dollars worth more today or in the future? I'm sure all of you guys know it's worth more today. At least I'd hope that's what you'd say. Because think about 20 years ago, how many candy bars you could have bought for $1 versus today, you probably couldn't even get one candy bar for $1 today, right? What about taxes though? Are taxes going to go up or are they going to go down? Well, I'll let you guys answer. Yeah, taxes will always go up. And if they don't, they're just going to find more crap to tax us on. So wouldn't it make more sense to pay tax on the seed versus the harvest? However, most of us don't practice what we preach with that because chances are all of you guys have some sort of 401k or employee sponsored plan. And what you're actually doing with that account is when you put those dollars in the 401k, you're actually giving up today's dollar in exchange for weaker dollars later. You're actually compounding the tax because the tax is always going to be there. And when you pay the tax on the money someday later, you're going to pay it on a larger amount. So you're not paying tax on the seed, you're paying it on the harvest. And if you did pay tax on the seed, you'd be paying taxes on the dollars today, not on fewer or future higher dollars. And this is the funny thing, because like I said earlier, people have been taught to give up control of their money. We literally have been taught to do things with money that we would never, ever do with things that money buys. For example, if you guys went right now to your local grocery store, bought a loaf of bread, drove it home, opened up the freezer door, threw it in the freezer, closed the freezer, and then waited 5, 10, 15 years, and then came back, opened up the freezer, and then took a look at your bread, then decided to eat it, you would never do that. It'd be freezer burned, right? So what about a car? Would you guys ever go down to the local car dealership, buy a brand new, beautiful truck, drive it home, park it in the driveway, and then wait 5, 10, 20 years and then go drive it? Of course you would not. But that's exactly what we've been taught to do with our money. We've been taught to give up control of our good dollars today for weaker, higher tax dollars later. And if you want to be good at money, then you need to start changing who's in control of that money. Even if, people come all the time and say they rationalize a 401k because they get the match, right? Well, what if the same example, you went to the store, bought a loaf of bread, came home, put it in the freezer, waited 10 years, opened it up, and then there was 2 freezer burned loaves of bread. You would still not eat it, right? So when I ask people about their retirement accounts, I can tell you what you know. You know very, very little. You know whether you're in a conservative, moderate, or high risk tolerance, and you probably saw your statement last quarter and saw whether it went up or down. and then you threw it away, and that is it. So what we've been taught to do is just accept that traditional way of thinking about money. But to truly build wealth, you need to challenge those old concepts, and you need to understand how money really works. So how does money actually really flow? If let's say, I'll give you an example. Let's say you wanted to buy a car for $25,000 and you had it sitting in your savings account right now. Could you earn more at 4% while paying 6%? Meaning, hey, what if I had 25 grand in my savings account right now? It's paying me 4%. It's crushing it. And I want to buy a car for 25 grand. What if I got a $25,000 car on a 6% car loan? And then I left my 25 grand sitting in my bank account earning 4%. Do you think you could earn more at 4% than paying 6%? Absolutely. Christopher's exactly right. Let's show you the math behind it. 25 grand sitting in a bank, 25 grand for a car, $25,000 at 6% for a car loan for 60 months. That grows to, let's do it. There you go. That's a $483 payment, which would mean you'd spend $28,999 over that 5-year period for the car. But if instead you left the 25 sitting in your bank at 4% for 60 months and didn't touch it, it would be worth $30,525. You could do this with any car, any price. Even if the rates were even further apart, these numbers usually math out. So yes, 1,000%, you can make more earning 4 while paying 6. But when you go to the local banker, that does not make sense. They don't tell you these things. The reason it can be this way is because of these different types of interest. Simple interest versus compound interest. If you pay down your car every single month, that means you owe less and less and less, whereas your bank account's compounding. So eventually it would exceed the other and continue to grow. Now, what we've talked about thus far today is just the foundation of what we've been taught to do with money, how people use their money, what's going to happen in the future with the financial system. So let's dive into now, what is the strategy we're talking about today? We're talking about the money multiplier method, right? Well, the 3 things that are a part of this method that will change your life forever is first, the machine, because there needs to be a machine that we use to keep our money flowing. And then the fact that this is a marathon. This is not a get rich quick scheme. This is not a sprint, but it is a marathon to building wealth. And last, the millionaire. Everybody's favorite topic. Really just your goal. If that's being a millionaire, great. If that's a multimillionaire, great. If that's a business owner, great. If that means you want more time, great. Whatever your goal is going to be the largest factor of how we build this method out. And so I'm going to throw into the chat right now my email address. If any of you guys do need to leave early, I saw somebody mentioned that, email me. Let me know that you left early. I'll send you the full recording, and I will answer any questions you guys have about this strategy we're about to dive into. I'm here to teach you this and help you in whatever way I can. I'm here to protect your knowledge around this. And so if you want to learn more after this presentation, that's my email to reach out to. Now let's talk about the machine to start. And you know what? The more I learn about money myself, the more I realize I actually don't know. It becomes an ever increasing journey of just financial education. There's always something new to learn. And so when I pose this question for you guys next about the machine, people really need to stop and think about it. Are there more efficient ways? Could it be possible that there are more efficient environments to store wealth outside of commercial banks that we're not aware of? So really think about that for a second. This should be a yes for most of us. Now, I don't think I'll ever get to a point where we know everything there is to know about money, but this is a powerful question. I want you guys to really think about this. What you haven't yet been taught, and I hope when it comes to money, we can have a humble learner mentality throughout our lives, because there's always more to learn. And remember, when I mentioned the Rich Dad Poor Dad and Tony Robbins and Money Master of the Game, like those money books, what do they always teach in those books? I mean, a lot of different things, but they always teach save 10% of your income. If you cannot save 10% of your income, you will never be wealthy. I hope most of you guys do at least that as the bare minimum. But in today's economy, the average American does not. They save 5% of their income. That's simply not enough. And in our American culture, we do not value savings. We don't value the retention of our dollars in our control. And I think one of the main reasons for that is because Americans are just not saving enough money because of the environments, the places that we've been told to store money. These environments like savings accounts, high yield savings accounts, CDs, 401ks, they are so incredibly inefficient that it's hard to save money because the money that we place in these environments simply don't do anything. So what we're going to talk about today is a function called banking. And this is a major paradigm shift for most people when they start learning about it. And the interesting thing about banking is that it affects every single component of your life. So wouldn't it be smart to learn a little bit about the banking function and how that actually applies to your life, right? So what is your bank? What's the bank we're going to use for this machine, the method, this whole strategy we've been discussing so far? Any of you guys know? I think some of you know, but let's just describe it a little bit. What is your bank? What are the attributes of your bank going to be compared to a traditional bank? Let's just start with a few. In your bank, the bank we're going to use to build our machine, it's going to be liquid. Just like in a traditional bank, these funds will be liquid. The average savings account right now pays 0.07%. Pathetic. Our bank, what if I could tell you your bank's going to pay 2 to 6% guaranteed, uninterrupted, and compounding, never to be touched? What if I could tell you the growth in your bank was tax-free, whereas the growth in your savings account's taxed? And it could be protected from lawsuits, judgments, liens, some bankruptcies in some states, and stable. Banks fail all of the time. You saw it during COVID. Dozens of banks failed. What if your bank never failed? It was always stable, even in uncertain times. Now, wouldn't this be a much more efficient place to store money? Now, this is a place you can control, you can count on, you can use as your foundation to finance everything throughout your life. And I get it, like being, if you're a business owner, if you have a family, you have a very intense job, I mean, you're always caught up in the chaos. So the opportunity to put some money somewhere that is still liquid, but it's also compounding, guaranteed, it is tax-free, it's completely risk-free from the market and the world. And what if I'd add one more thing, that if you were to take money out of your bank, it's not going to stop the compounding. Now that's something everyone should dive deeper into. Wouldn't you agree that this would be a much more efficient place to store your money? So let's get into what this is that we've used to be our bank. What's the machine a part of this whole process? You guys got it right. It's nothing more than just a dividend paying whole life insurance policy from a mutual company. This is the machine we're going to use to build wealth. Now, what the heck does life insurance have to do with building wealth? This is the point when a lot of people actually want to leave. So if you do, you guys can go now. If you stay, you're going to get the good stuff. Because this is what the rich, the elite, the wealthy people do. And that is what we teach. We help build these policies to become the bank. And if you don't believe me, then look at these people right here. You all know these people's faces. Top left, John Rockefeller. He built one of the largest American empires in history. He built his foundation on whole life insurance. That is how still to this day, his great grandkids or whoever his kin are still very, very wealthy. Walt Disney on the top right. How did he start Disneyland? Oh yeah, with this whole life insurance policy. How about the two guys on the bottom right? Warren Buffett. You guys know these guys? Bill Gates. The ultra wealthy have reportedly over $1 billion in life insurance. And how about the politicians on the bottom left? We all know these guys. They're on the news every single day. Both of them, no matter what side you're on, doesn't matter. Both of them have this strategy and they incorporate it in their families. Both of them are rich, right? When Biden became president 4 years ago, his financial statement actually was public, and he had 4 policies built like this on his financial statement. That should tell you a little bit something about what we're doing. And you know what's actually crazier than all of this? The number one purchasers of whole life insurance in the world is none other than traditional banks. If you look this up, BOLI, bank-owned life insurance, you can find it. You'll find that every single bank owns more whole life insurance, not IULs, not term insurance, whole life, than they own in land, and buildings combined. Banks are the #1 purchaser in the world. Not only do they own more whole life, but banks keep buying and buying more every single year. So you have to ask yourself, are banks stupid? Or do they just know something that I don't know? Between these 4 banks, guys, that's over $60 billion in whole life insurance. Guys, they're not stupid. They're smarter than I am, smarter than you are. Let's just mimic them. We're going to just do what they do. So what do banks do? Well, let's talk about it. Let's say you have a awesome bank. They're paying you 4%, and so you decide to leave $100,000 with them. You decide to store it here, and they pay you a great return. You're pumped, right? What does the bank immediately do? The bank goes and makes that money work for them. They go find some place to invest it. So let's say your neighbor down the street's buying a new house. They're going to get a loan at 7%. Well, then what is the seller going to do when they get the profits from the sell? They're going to go put it right back in the bank, right? Then let's say your other neighbor needs to go buy a car. So the bank has the funds, they go do another investment, they lend it out to someone buying a car at 8%. Who's going to pay the car dealership? Who's going to put the money again? Where? Well, let's say someone else needs a home remodel loan done on their house. And because it's not a secured loan, or maybe it's second position on the house, they charge a higher interest rate. So it's 9%. Who's then going to pay the contractor? And where's the contractor going to put his money when he makes the money? And then let's say someone goes and blows all their money on red in Vegas. They lose it all. They're in debt. They owe 12% on a debt consolidation loan to pay off their credit cards. And then credit card companies put it back in the bank. Guys, who's in control of all of these transactions? The bank. All right, in control of everything. And how much risk did they take? Very little. While you were earning 4%, the bank made 7. While you were making 4%, the bank was making 8. They're making a 4% spread. When you were making 4, the bank was making 9. They were making a 5% spread. And then lastly here, they're making an 8% spread. So if you total all of those spreads up, they are making 20% more than you are on your money sitting at the bank. Let's do that math. Are they making 16% more than you? You're making 4, they're making 20? No. 4 goes into 20 5 times. They're making 500% on the money you are leaving there. They're making 500% more than you are making every single year. If you go to bauerfinancial.com, you will read that banks make between 413% annually on the money you leave there. You can look up any bank's financial reports for the last 20 years on this website. It's really cool, actually. But this is why when you go to any downtown area, any main big city, who owns all the largest buildings in town, the best property in the nice corner lot? The banks do. This is why, because you are paying for it. So earlier when I told you guys these banks are the #1 purchasers of these specially designed policies, the thing I asked you was, are banks stupid, or do they know something you don't know? Guys, you probably should know now. They're not stupid. They know something we do not know. And not only that, banks understand statistics. They understand how people spend their money. We all have car loans, mortgages, and guess how the interest is structured on those loans? It's all front loaded. The first 5 to 7 years, all the interest is packed in because they know most people move every 5 to 7 years. So they're going to get all their interest up front. So it's less about the percentage of interest you're paying, the number, the rate, and it's more about the velocity, the volume of interest you're paying. That's what's more important. So in America, we save 5 to 10% of our income. We then spend 30% of it on a house, 20% of it on a car, the rest on everything else. Guys, banks are controlling everything going on in our lives. The financial institutions are as well. And so how can we control our money in a private place? How can we have our funds somewhere that we are earning interest, that we are compounding, that we're tax-free, that we have liquidity and we can utilize? That's what this whole system is all about. That's what I'm here to share with you. If you can build one of these specially designed policies and store your money here and then use this as a savings vehicle and then finance everything through it, there you go. Now you are in control. You are the bank. Jeff, I see you mentioned in there you're heading out right now. Again, I'm throwing in my email in the chat. I don't have your email. So anyone who else needs to leave, that's my email right now. Email me your questions, thoughts with this. I will give you much more information on this concept. Now, let's talk about how you can now utilize this policy. Let's say you have this policy set up. This policy is the place you store your money. Now, for the future, anytime you need it to go make a big purchase, to make an investment, your money is now sitting in your bank, your policy. So now you're going to pull from it to go make those investments, those purchases. And if it's your bank, you're taking a loan against it to go do these different things, then you would pay your bank back with interest, right? You're just like you'd pay any other bank.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
Let's go through a real life example of this. I want to show you guys how to buy a car with a policy. This is a sweet truck I found a picture of. You can use a policy to purchase anything, but a car is just a very easy example. And I'm actually going to show you guys how to get all the money back for any truck, any car you ever buy, drive, or own. This is an example of a policy. This is an example of the machine we use. Now, please do not focus on these numbers. I'm going to go through it step at a time, one step at a time, and it will make a lot more sense when I do. So don't worry about it. But let's just understand the policy itself. Let's understand this machine. Well, for you guys to understand it, you need to change your mindset. Because most of the time when people think about life insurance and a premium, they think of it as a bill. They think of it as a payment, as bad, not good. But it is not that at all. If it's structured correctly, it's a deposit. Because a deposit at the bank is just putting money there and it's liquid. Same thing here, guys. This is a specially designed whole life policy, not a regular one. This is life insurance where you have liquidity right off the bat. So if you can take the money right back out, then yeah, it is a deposit if it's structured correctly. And so we need to start changing the way you think about a premium. You need to think about it as a deposit from now on. And second, people come to us and say, well, age is a big factor when getting life insurance. Certainly true. However, in this situation, it is not that important. I've set policies up on their brand new babies once they were born. I've also set up policies on people in their 70s. So it does not matter. The older you are, the less time you have to live. So all things considered, that just means you have less time for your money to grow. So the main difference is going to be that your death benefit's not going to be as big compared to someone who's a brand new baby born or a baby boy or something like that. So age does play a factor, but not on the banking aspects, just at the death benefit. And again, the death benefit is not the main reason we're building this policy. We're building it as a place to store money. So age does not matter, and the death benefit is not the largest reason we're doing this. So I'm going to actually minimize the death benefit on a policy like this to maximize how much growth you have and maximize how much is available to you to access. So the death benefit is important, but not the main reason we're building this. And so I want these, couple of things to stick into your mind when we go through this. Let's jump into it and show you how to now use this policy to pay off a car or buy a car, let's just say. So in this person's example, so he decided to put $10,000 a year into his policy. These are his deposits. We're 7 years in, $10,000 every year. The reason he chose this amount was because that's how much he currently saved. So he thought, well, hey, if I'm saving this at my Wells Fargo account, wouldn't I just rather save this in my bank, my policy? We said, there you go. That's exactly right. So that's what he decided to do. He's now saving 10 grand a year in his policy. And then on the right side is cash value in money multiplier account, cash value in the policy. The cash value in life insurance is how much money you can utilize. I like it to look at it as the equity. This is the liquidity. This is what you can utilize in your policy. In the first year, he had access to $5,800, 60% of his funds. Year two, $12,000. Year three, it drops to $4,000. Because I want to show you guys how he can go and buy a car. So he's going to take $25,000 out of his cash value and go and buy a car. It should show 29. Okay. Now he takes 25 out to go buy a car. Now, if he's going to take $25,000 out as a loan against himself, then what should he do? Well, he should pay himself back for sure, right? Well, if he's going to pay the bank, I think we did the math earlier, 25 grand at 4% or 6% was $483 a month. Let's just round up to 500. Let's say he pays himself back $500 a month every month as if he was paying somebody else. Perfect. Takes 25 out of the policy, pays himself back $500 a month, which is $6 grand a year. for 5 years, 60 months. It's like any other car note you'd get anywhere else. Okay, let's look at the math. He's put in 70 grand as premiums, premium deposits. He's put in 30 by repaying his policy loan. And so $100,000 out of his pocket has gone into this policy. He also took $25,000 out and has a car bought free and clear sitting in his driveway. He's been driving it for 5 years already. So his net injection into this policy is 75 grand. He put in $75,000 into this policy over 7 years. And look at how much cash value he has available. $67,881. Do you guys see that? In the 7th year, his cash value is 67 grand, which means he got access to 91 cents on the dollar. He put in 75, he has access to 67. So he got 91 cents back on the car purchase. I'll let you guys soak that in for a second. He just got 91 cents back on every dollar he spent on his car. Do you guys think the math doesn't make sense? Let's go even further. Let's say in the 8th year, he doesn't want to put any more money into it. He's done, and he wants to take another loan to go buy another car for his wife now. Takes $25,000 out of the cash value, goes to buy a new car, and pays himself back $500 a month, just like he would pay anybody else, right? So over that new 5-year period, $0 of premiums, $30,000 of loan repayments, and he also bought a car for 25. So his net injection into the policy is 5 grand, right? Now take a look. His cash value in year 7 was 67 grand. In year 12, it was 91 grand. So his cash value increased by 23,000, and he put in 5. He just made 4 times his money on buying a car. Everyone in the chat, what is that? How does that resonate with you? Does that make sense? This is confusing. I know this is a lot of numbers. Let's look at this on a larger scale. In the first 7 years, he put in 75 grand. In the next 5 years, he put in 5 grand. So he put in $80,000 in total into his policy. And if you look in year 12, his cash value is 91 grand. So 80,000 went in. He has 2 cars fully bought, paid for, and has 91 grand left over. He made money off of buying 2 cars. Guys, that's what you can do with everything. If you are the bank, you are earning interest on everything. You are in control. This is just a simple example of buying a car. And with everything I just showed you, all we did in this whole scenario was change one thing, and that was where your money went first. You putting your money in a 401k or savings account or some other vehicle is the only thing we're changing. If you now store those funds in your bank, your policy goes here first, and then we carry on and keep doing the same purchases throughout our entire life, buying cars, going on vacations, but doing it through a place we control, and we pay ourselves back. Look what happens. Remember, this strategy doesn't change how you spend your money. It doesn't change what you invest your money in. It just changes where your money resides while you do it. There are some rules when you do this. So let's talk about some rules. Rule number 1 and 2. Rule number 1, pay yourself first. Rule number 1, he pays himself first. 10 grand a year he puts into his policy versus somebody else's bank. Rule number 2 is he pays himself back with interest. He doesn't steal from his bank and not pay himself back. If he's going to take a loan from himself, he's going to pay himself back. Rule number 3 is he recycled and recaptured all of his money. Because wouldn't it make more sense to pay you all the interest and not somebody else? You'd get a lot more out of the interest if you did that, right? So that's an example of purchasing something like a car. That could have been a vacation he purchased every 5 years. That could have been anything, really. Now, let's talk about debt. A lot of people on here, most people in America have debt. Credit cards, car notes, homes. So can we utilize this strategy to do the exact same thing I just showed you? Changing one thing, which is where your extra money goes first. And how can we then use this to pay off your debt more effectively? So this is an example. This is Kevin. This is someone in our community we worked with. He had all kinds of debt. Look at this, guys. He had, what is that? Like 10 different debts, some credit cards, private loans, car, a condo, a second house. Like he had all kinds of things. $478,000. I don't know if any of you guys are similar in debt as this guy. He was paying $5,770 a month. I would be dying if I had to pay that much a month in debt, but he was doing it for years. And he came to us and said, hey, how can I pay this off better. I want to get rid of this interest I'm paying. Right now, I'm just throwing extra money at each card. I'm throwing extra money at the house when I can. He's just freestyling. And we said, well, okay, what are you saving after all your income, your expenses? He was a chiropractor, so he made good money. He said, after everything, I save about $2,000 a month. And that's what I use to kind of spread apart on all these different debts. And I said, great, don't do that. Save $2,000 a month in your policy. We're going to put all your extra income here first. Again, that's the one thing we're changing with all of this is just where your money goes first, right? That's what we said. $2,000 a month is now going to go into this policy. So it was going to take him 19 years to pay off his debt the way he was previously doing it. And then we changed. We said, great, we'll put $25,000 into the policy. It's about $2,000 a month. Once he deposited that into the policy, we had about $15,000, $14,800 of cash value available to utilize. We said, fantastic, let's take it out, let's use it. We took that money out of the policy, paid off these 2 cards right off the bat. Did not hesitate. But what do you do when you take a loan from yourself? Talked about this earlier. You pay yourself back. So if he was paying $161 for his Discover card, $287 for his Lowe's card, and those debts are now gone, what is he going to do with that freed up income he was otherwise paying to somebody else? Guys, I'm beating this in your head, but you guys know this. You should pay yourself back. That is what he did. He paid himself back $448 every single month, which is what those payments were. So now he's paying $5,329 in debt payments, and he's also paying himself back now $448. Fantastic, right? A little bit less paying other people, a little more he's saving, paying back himself. So year number 2 rolls around. He pays $25,000 again in the premium. His cash value increases by $16,000, so he can take $16,000 out to contribute and kind of work with. And he also paid himself $448 a month, which was $5,300 by the end of the year. So just by putting money in his policy, paying himself back, he had 21, almost 22 grand available to now utilize to pay down his debt, which there he does. Boom, boom, boom. 3 more debts are gone. And look at those payments he had, 276, 271, 922. What does he do with those payments now? He pays himself back. So there you go. Now he's only paying $3,800 in debt payments and paying himself $1,900 a month. So year number 3 comes around, 25 goes in, his cash value grew by 25,000. Take a second and look at that. Put in 25, he had access to 25. Just 3 years into having a policy, his policy is producing enough cash value compared to what he's putting into it. That's phenomenal. Okay. He also paid himself back $1,900 a month. That's $23,000 in a year. So he had $48,000 now to use, which he does to pay off the next 2 loans, which frees up more cash flow. He has more money to save, and now he's really cooking. He's just 3 years in, guys. 3 years. He has all this new extra income to save. He only has 2 loans left. He is crushing it. So let's kind of sum this up real quickly. What's happened thus far? How much did we put in? 25 in the first year, 25 in the second year, and 25 in the third year. And how much did we take out as loans? 14 in the first year, 16 in the second, and about 25 in the third. So how much is left in the policy? That's the question. Is it the $20,000 difference? It is not. It's the full $75,000 that he has put into his policy over the 3 years. Remember, you are not taking the money out that you put in. You are borrowing against the cash value against the insurance company, using your premium, using your policy as the collateral, and you're taking this $55,000 loan out and you're paying down your debt. Your 75 is still sitting in the policy, still compounding interest, which, remember in the example I gave earlier, you can make more earning 4 than paying 6. This is that example. His 75 is still sitting there compounding while he has a loan out. He's making money while paying down his debt. So let's keep going. 4th year, 25 goes in, 26 in cash value. He pays himself back $3,600 a month. He has $70,000 available, chunks down the condo. Doesn't pay it off, so the payment's still the same. So he just does it again the following year. 25, 27, 44, 71. Pays off the condo. All that's left is his house, baby. He's ready to go. Well, the funny thing happened on his policy. After the 5th year, he had to change it up a little bit. The insurance company did not allow him to put all the 25 in again, and he was only able to put in $10,000 a year after that. But he also came to us and said, hey, my business is doing better. I have more money I save. Let me do another policy. So that's what he did. He put in $10,000 into his first policy, and he set up another policy for 25 grand a year. So 10,000 deposit in the first policy, 25 in the second. And if you look at the cash value in the $25,000 policy, it's 14. Back to the start, right? In the first year, he put in 25, had access to 14, same scenario. But his older policy, that's 6 years into it, he put in 10. His cash value is growing by a lot, 13,000. He has 30% access more to his money than he put in. So combine those two cash values plus that repayment paying himself back, he has 82 grand left over, and he pays that house off easily. Now, guys, think about what just happened. He paid all of his debt off in 6 years where it was going to take him 19. So what if you have no debt? What if you don't need a new car? Can you still benefit from privatized banking? Should you still become your own bank? Well, yeah, you should. I don't have any bad debt. I don't have a new car to buy, and I'm doing this every single month. And it just gets more fun because now you don't have leakage and baggage to worry about. Now you can go build assets. Now you can take money from your policy to go buy rental properties, to go start a business, to go increase your income somehow. So the fun just now begins. It only will get better from there. Now, what if you continued paying back the houses back as promised? You know, when we paid off the condo and the house, you still had a lot of payments left. He had 251 months left in his condo and 220 left in his house. He was going to spend a lot of money still on paying down these things, but he decided to pay himself back after he paid those debts off, which means he paid himself back $493,000 over the next 250 months. Because instead of paying the mortgage company, he paid off his debt, and now he's paying back himself. He's going to pay himself back almost 500 grand instead of paying somebody else. So by using this strategy, you now have all the money in your account rather than in the banker's pocket. Now, let me ask you, now that you know this, should everybody be doing it? In my opinion, I actually believe yes, 99% of Americans should. Does not mean you have to do on some large scale, 25 grand a year, but everybody should be doing this in some scale. If you're not, I believe you're stealing from your kids and your grandkids. You're stealing from your next generation. It's really what's happening. I don't care if you make $10 an hour or $10,000 an hour. It really doesn't matter. This can work for anybody. If wealthy people are doing this, they have a reason behind it. And they do it because they know what it can do for them. They understand how to keep money in their families. This is how. So we need to break the bonds of financial slavery that we have here in America. If we don't, we're going to continue to be stuck. We're going to continue to be in debt, not having the success or the wealth that we actually want. When you guys do this, you're setting yourselves up, but not just yourselves, the people around you, for the future. You're taking care of everybody. And so when you use the strategy of infinite banking, like we show you, like I can help you do, you're going to make that money go work for you. If you're constantly trading time for money and you're not doing anything else, it's a vicious cycle and it's hard to get ahead. It's hard to actually have any wealth because the money's not working for you. You're working for the money. So infinite banking is about controlling your money. It's about getting that money out working for you. Now, I want to get to some main questions here. By the way, actually, you know what? Some by the way stuff. The policy grows tax-free. We already hit that. The death benefit is tax-free. The policies are safe from judgments and liens. We talked about that. You could use the policy to finance retirement income. You could use it to finance kids' colleges, policies on them, businesses. You can use this for anything. And how do you fund your policy? Well, you could fund it monthly, quarterly, annually, however you wanted. You could do 10 times your age a month. That's probably the minimum I'd recommend for you to do. If you're not able to save at least 10 times your age a month, I would not say this is something you should do quite yet. I would say it's the bare minimum you should do. And Brian, I see you asked the question, what's the minimum age to start a policy? You can actually start a policy on a brand new baby. The second they are born, once they have a social security number, they are registered with the country, they are eligible for life insurance. They will not own the policy. They will not fund it, right? They're babies, but you can own it and fund it yourself as the parent or grandparent or uncle or aunt or friend. So anyone that has financial interest in you, you can get a policy on them. But to Anthony's point, you cannot own a policy or start it yourself until you are 18. but you can get a policy on anyone, any child. And the maximum you put into a policy is really up to you. You could put as much as you possibly wanted into it. We have people who are putting in millions of dollars a year into these type of policies. So it just depends on you as an individual. And on top of a premium deposit that you're doing every month, every year, you can do a large lump sum or a small lump sum to start the policy. So let's say you're 50, you're doing $500 a month because that's what you comfortably can save and that's it. Then on top of that, you could dump money into it. You could dump 10, 20, 30 grand just to get it started. And you will have access in the first 30 days to 60 to 90% of that total deposit. You have access to everything you put into it as well. And so when we talk about these policy loans, if you do take money out of the policy, the way I look at these policy loans is kind of like a line of credit. So the cash value in your policy and the policy loans, interchangeable words, same thing. I use both, so sorry if it's confusing. But these policy loans are guaranteed. You can take a policy literally whenever you want. The insurance company doesn't ask for your credit score, your history. There's no approval. You ask for the loan, they give it to you. It's that simple. And I said I look at that like a line of credit because it is very similar to a line of credit in their traits, where if you take out a line of credit from the bank and pay back some of it, whatever you pay back is available for you to use again. You can take it out again and go do something else with it. Anything you pay back becomes available to use. So same idea with these policies. And these loans are private. They do not go on your credit report. There are no minimums or maximums. You are in control of these loans. If you don't want to pay your policy back for a month, you do not have to. If you were to go get a car note with the bank and you missed a payment, you are screwed. Your credit will be dinged. If it's long enough, you have a bad history, they could come and take your car from you. In this situation, if you miss a payment, you're in control. Look at yourself in the mirror and make a plan of how you're going to figure it out. But you can decide how you do that. So why the money multiplier? Why us? Well, first off, I personally will help you and show you how to implement this strategy completely free of charge. My team and I do not charge you anything. We get paid from the insurance companies for the business that we bring them. And so that's how we're taken care of. I'll never manage your policy, invest your money, pay off your debt. I'm not touching anything. You're not giving me anything. We are just a third party to help make sure you build this right and use it right. And I've met with over 2,000 families across the country, showing them how to build this strategy out for them. And between our whole team, I mean, we've probably met with over 20,000 families across America or reached that many people. Our team has a lot of unique pieces, and we actually have dedicated underwriters at insurance companies and some special policies at insurance companies that work for just our members in our community. So that's pretty cool. And I actually believe we're the largest producers of these type of infinite banking policies in the country. And that's because we have a lot of repeat clients and referrals because we treat our clients the right way. We aren't here to just sell you a policy, but teach you how to become the bank. And that happens after the policy is set up. And so we want to set up the policy, of course, but then show you how to utilize it. And there's a lot going on in today's world. People will come to us and say, my local insurance agent sold me this policy, look at it and see if it works for banking. And it's usually horrible. You cannot go to your broke brother-in-law who sells insurance to get a policy like this. You have to go to a banking professional to get a policy like this, to get educated on how to use it. A traditional financial advisor, CPA, insurance agent will not know how to do this, or they'll tell you they do and they'll sell you the wrong thing because they're there to just get a commission. So just to add on to this further, I do this myself. I'm not here to just preach on my high horse. I do this. My mentors on my team use this. We all are a part of this strategy, and we've been using and teaching it for a long time. And the last thing I'll mention, because it gets a lot of attention, is using an IUL, an indexed universal life policy, or a VUL or term insurance. Can you use those products for infinite banking? The short answer is no. Those insurance products are for different purposes. They sell the highest commissions, which is why insurance agents push them, but they will not be meant best for banking by any means. If you want to have a deeper discussion on those topics, we definitely can. That's all I'll say about that. And lastly, let's talk about this. Only one of two things will happen in your guys' life. One, we're going to die. Two, we're going to live. Both will happen. Are you better off with or without this while you're alive? Well, duh, I just showed you how to pay off your debt faster, how to buy cars and get money back for it, multiply money in investments. Easy. Yes, you're better off with it than without it. Now, what about your family? If you passed away and you didn't have this set up, they would get nothing. If you do, well, good thing a death benefit's attached to all this. They're going to get a large lump sum of money paid to them tax-free. You are not just taking care of yourself today, but your family in the future. So yeah, it's definitely better for them and you in this whole scenario. And the last thing I'll end with here is a quote by Warren Buffett. If poor people would just do what rich people do, they wouldn't be poor anymore. Guys, Warren Buffett, one of the richest investors in the world, owns an insurance company. I wonder why. He knows. So I showed you guys today how the wealthiest families, the wealthiest corporations, banks utilize this concept. If you would just simply do what they do, you would not be poor anymore. And if you're not, I'm sure most of you are not, doesn't matter. You can find ways to protect your money and grow it in a more efficient manner. Now, how many of you guys could actually see yourself doing this? Well, here's the thing. I'm going to give you guys an opportunity. First things first, because everything I've talked about thus far is things you can incorporate. In a moment, I'm going to put an important code on the screen. And when I do, you're simply going to put your camera up, click on the link. And what that does for you is it will secure your personal copy of my presentation, and it will allow you to have a one-on-one conversation meeting with me, answering any of your questions. You guys didn't come here to procrastinate. You guys came here to take action. This does not mean you need to set up a policy today. This means you need to learn about this further and do due diligence so you can actually set your family up. This link, carson.beyourownbanker.com, will send you directly to my calendar, and that link on the QR code on the left will send you to that calendar as well. It's not Carson be your own bank. It's Carson.beyourownbanker, Chris, which is why it probably didn't work. But if that QR code on the left isn't working, then you can click that link. And then on the right side, that sends you to my Instagram. I would love for you guys to follow my journey. I want to be a part of your guys' journeys. Follow me on Instagram and learn how I'm incorporating this strategy, learn how I'm doing real estate with it, because that's my main thing. And then DM me. Let me know what your thoughts were on this presentation. If you want more resources, I will send you anything. If you guys just want to learn more about the strategy that I've talked about today, we have hundreds of videos. I will send you anything you guys want. Books, YouTube videos, links, podcasts. I just threw in the chat my email. Here is beyourownbanker.com. Here's the link if you want to book time with me to ask those questions. Either of those work. Email me your questions, your thoughts. If you want more resources just to be more comfortable with this. If you want to have a one-on-one call where I just spend time talking with you about this, we can do that as well. Now, we have a lot of you still on here. Let's take a look. Everyone's still on here. I have another 15, 20 minutes. So if you guys do want to go through questions, let's do it. I got plenty of time for you guys. So any questions you've thought of while going through this, anything you wrote down, hold them up, throw them in the chat. Let's go through them together. Donald, if you want to send this link to somebody else who you think can incorporate this strategy, email me. Just send me your name and the person you want to send this to, or do like a three-way email or text chain, and I will send them this presentation. So again, throwing my email here in the chat. Email me if you want to book time to talk with me. I sent that in there as well. If you guys would like more resources, anything, you can reach out there. Anyway, we got some time. What are your big questions? I might have missed some earlier in here. I think I saw you guys put something in the chat. Let's see. Okay, so this question from someone on Zoom. You will help us decide what type of whole life insurance policy to buy. That is correct. I'm licensed as a life insurance agent. We are contracted with many insurance companies. Based upon what you're trying to accomplish, we will build a policy for you, for banking. It is, you said what type of policy to buy. I mean, we have a specific way to build these policies, but I think that's something we'd figure out together on a conversation. So if you had questions and you want to figure out how to build this for yourself, then let me know. We can go through your situation together. Someone said, hey, I'm 87 years old. I have second stage cancer. I have high blood pressure, high cholesterol, sleep apnea. Can I qualify for life insurance? To be honest with you, Jorge, most likely not. You probably would not be able to get a policy, but that doesn't mean you can't get a policy on a child, grandchild, great-grandchild, and you could do the exact same thing we've been talking about. You could store your money there and it will be on their lives. What about a group call? Can we set that up? Sure. Yeah, go ahead. Click the link, carson.beyourownbanker.com. It'll send you my calendar. and then add other emails on there. Add emails of whoever you want to join. We'll do a big group meeting. We can definitely do that. Catherine Powers, is there a way to get the recording? Yes, go on Chris Naugle's YouTube in a couple days, or tomorrow probably. This will be posted. Or email me at carson@chrisnaugle.com, and I will DM it or email it back to you right away. The policy takes time, someone said. Say 1 to 2 years to be able to utilize the money. Well, in many of my examples, I showed you taking money out right away. So you never have to wait. But if you're putting in, $200 a month into a policy, then yeah, you're probably not going to have anything and not, build big enough to use to go do anything significant. So you probably want to wait to build up the funds. But no, I mean, if you have what you need to do what you need to do, then you can take money out second your policy started, day one. You don't need to wait years to do this. It could be right off the bat. Someone said, hey, I am 63 years old. I have 350 grand of debt. What would it cost to set this up? Meaning the deposits required monthly. You can build this policy however you want. We could build it where you were putting in $100 a month into it. We could build it where you're putting in $1 million a year into it. I don't care how much you're doing. Obviously, the more you put through it, the faster you'll pay down the debt, the more you're saving, the better it'll be off for you. But if I would just do what you can start with. And if that means we insure you or a family member or someone else who's younger, great, easy. We can do that. I think preferably the first policy should be on you. So there's some coverage on your life. So if it was on you being 63 years old, I probably would tell you to at least do 10 times your age a month, which would be $630 a month. So if you're able to comfortably save $630 a month, then this is something you can incorporate. If you're not, then maybe we put a policy in a younger person. Maybe we set it up on you anyways and find a way to structure it efficiently. I mean, you have options. I think more so than anything else, it would just depend on everything else going on. So let's probably have a one-on-one conversation, Sarah Lynn, and talk about how you can build this system out for yourself. Thomas Stewart said, is this a good process if I'm currently consolidating debt? 1 million bajillion %, my man. If you saw the example of our chiropractor paying off all of his debt, you can do the same thing. I don't care how much debt you have. Think about how much you are paying to somebody else. Think about how much interest you're paying to somebody else. Wouldn't it be nice to recapture all of that money and pay yourself that amount? Right? Simple enough. Yes, it makes sense for you to pay off your debt through a policy. I would do so. Somebody said, I'm receiving disability every month. Is this an ideal situation to start IBC? Yeah, I don't care how you get income. Doesn't matter. You can set up a policy. Does not matter where your income comes from. Would you recommend, fascinating question here, Chris, would you recommend using a first lien HELOC to fund a policy and then use to pay off debt and or begin investing in something? So if this is too complex for some of you guys in here, just disregard this question. But he's asking, can you basically get a loan to fund a policy and then use that policy to then maybe pay it back, maybe make investments, whatever? I think it can make sense. You would just have to make the numbers work. If you have an adjustable HELOC rate that could be 12% any day, and the investments you're going to do is 12%, then there is no way I'm taking out a HELOC to make no spread just for the fun of it, I guess. I mean, you're taking on more risk for no reason. So I would only use a loan to fund life insurance if it is absolutely necessary and you are confident and comfortable that things are going to work out well mathematically. Then all day I would do it. It just has to make sense. There are people in our community who do it all the time. So I'm not saying it's bad. D.D. Bright said, is the money in the life insurance policy insured, FDIC or some other situation? I think this is a hilarious question because I think we're taught in America, like, you want to be FDIC insured. You want that security. Guys, you know what the FDIC is insured by? The government. And the government is in $23 trillion of debt. I don't care if it's FDIC insured. You're insured by someone who's $23 million or $1 trillion in debt. It does not help you or secure you in any way or fashion. I could care less. What I'd rather have is a safe private institution to store money that guarantees you with a contract that your money is going to be safe and available for you whenever you want, no matter what happens in the world. That's who I want to work with. And that's what these insurance companies do. These insurance companies are setting up a private contract with you. The whole life insurance policy, it's a private policy, and that money's liquid for you to take out whenever you want, no matter what happens in the world, and it's guaranteed to grow. Now that is a safe place to store money, not a bank. Let's see here. So if you wanted to put money from the sale of a big item, say it's 100 grand or something, how does this get reported to the IRS? Is it taxable? I guess that's the question. So if you wanted to put money from the sale. So I guess you're probably asking, are premium deposits a tax write-off? Meaning, hey, you make money, can you throw it in life insurance and not pay taxes on it? The answer is no. Policy premium is post-tax dollars. So no, you'd still owe taxes on any big sell you did or something before you put it in life insurance. Now, the growth in the life insurance is tax-free, like a Roth IRA. So that's the tax implication of it. But no, I mean, you can't avoid taxes by doing life insurance. What's the process to borrow from the policy? Do I just contact the company I'm with? Exactly. Yeah. You have an online portal with the insurance company directly. You would request a loan on that platform and they send you the funds via a wire within a couple of days, or a check if you wanted. So fairly simple. Yeah. It's not like you're using this policy for your, groceries or your spending every day. It's more so for money you save and then big plans like debt payoffs, investments, things like that. How much does your service cost? He asked. There's no cost. I mean, you're setting up an insurance policy with an insurance company and you're using it for banking. We are here to just teach you how to do so, and we are paid from the insurance companies for the business that we bring them. So there's no cost. Isn't the growth taken out as a loan, therefore tax-free? That's exactly right, Patrick. You're taking money out of the policy as a loan. You're never withdrawing from it. So you're never going to owe tax. And Anthony asked, can you explain why one might need a PUA and a 7-year term rider? I mean, you said you have a policy as a month ago, so you should probably ask your IBC mentor, because that's a pretty long conversation and something you should have learned a long time ago, to be honest with you, if you have a policy already. I guess the short answer would be paid up additions are premium into life insurance. It's premium into life insurance that has cash value guaranteed and right away. So if you can get money into life insurance environment, still have access to your money, and it's going in as premium, meaning it's going to continue to earn a dividend and keep growing, awesome. I mean, wouldn't we want more premium going towards that than to any actual cost of life insurance? So every time you pay a premium, a portion of it goes to your paid up additions rider and a portion goes to the base. So we can build this to have cash value right away. And you'll only have a 7-year term rider if we need to get your death benefit high enough for you to do some sort of lump sum. Other than that, there's no reason to have term insurance on there. Thomas, you want to move forward? Yes, that's exactly what this whole thing is about. My link is right up there. If you want to move forward, go to that website, carson.beyourbanker.com, and you will meet with me directly. We'll have a 30-minute call, meeting, Zoom, just going through your situation to decide how you can actually build this for yourself. There's no cost to do so. You're literally just setting up a policy with an insurance company. And then you also asked, do some policies max out? Yeah, you can't just throw money in whenever you want. There's structure to it. So that would be something we could figure out together based on what you're trying to accomplish, how we should build that. Any last questions? You guys have my email, my link. If you guys just want resources, email me. You want to talk and meet to set one up and learn how this works, let me know. Other than that, tomorrow we have a wealth webinar presentation. If you are on Chris Naugle's YouTube tomorrow, at any point we have a live webinar going on. You can do more Q&A on. And if you want to or live near Nashville, Tennessee, next weekend, we're all going to be out in Nashville in person having an event. So please reach out to me and email me if you want to attend that as well. Let's see, last question. How many times can you borrow from the account in 1 year? You can take loans from your policy whenever you want, however you want, as many times as you want, and pay it back in the same manner, whenever you want, however you want, in whatever order you want. You are in control of the whole thing. And with that, let's end with control, happiness, opportunity. Guys, there's so much opportunity out there to make money. Go out there and crush it, guys. I'll see you next week.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.